From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, U.S. payrolls coming in stronger than expected. Traders pushing back their bets on a Fed rate cut to December. And thanks to the data, Treasury yields surging across the curve. But we begin with the big issue. Payrolls change the conversation.
This is a really strong report on the demand side.
Stronger than what people were expecting.
The non-farm payroll number,
payrolls data,
probably the most market-moving data point of all.
It does close the door on a July rate cut.
Jobs, labor market, consumer spending, those are the key kind of risks to be monitoring.
We want the labor market to normalize.
There's a limit to the painless labor market rebalancing that we've experienced.
At some point, you do have to deal with the slowdown on the way to those rate cuts.
The risk for the chairman is to cut too early before there's any economic weakness, and then having to reverse course.
The next move that the Fed is going to make is ultimately going to be one that protects the strength of the labor market rather than one that in which they need to be fighting inflation.
The bar for bad labor market data for the Fed to be cutting sooner than the market is pricing is pretty low.
It all ties back to this labor market report.
Now let's start by looking at treasuries across the curve, because of course when we've seen that stronger than expected payrolls data, you just saw an absolute surge from the 2 years to the 30s, and you look at the 2-year, you're now standing at 485, 13 basis points higher. Certainly now higher than where we've started the week, but lower than where we started last week. The trend has been a bit lower, but still, you've seen some critical levels being crossed here this week. You saw the 10-year that earlier in the week was below 430, firmly below 430 actually, now jumped past that 440 level. And if you look at across the curve, the moves have not been quite proportional, which means that you're standing at a 210 curve that is more inverted this week than it was a week ago. But the 530s are less inverted. Of course, a lot of traders across Wall Street betting on those steepeners, and some of them feeling very burned today. Want to flip up the board here and also take a look at the changing expectations on when exactly we might see that first rate cut. And that top line there is that expectation for as early as September. And you saw in the middle of May, it was almost a sure thing. You saw more than a 50% chance, at least, that a September rate cut would materialize. And you now see that if September through November, those chances are still very much wavering here. And the December rate cut is the only one that is seen as more of a sure thing by the market. Now, we saw the economists over at Citigroup, who were some of those last holdouts still predicting a Fed rate cut back in July, push back their forecast. They wrote, "We are shifting our base case for that first rate cut from July to September due to surprisingly strong job growth." We're going to see now what our guests think. Joining us now is Matt Diczok of Bank of America and Gargi Chaudhuri of BlackRock. And Matt, you had written over to us that really it's about not just inflation here anymore, but the idea of what jobs can mean for the Fed's picture. And of course, the market seems to agree.
Yeah, we're not concerned about this job report. It's a continuation of all the themes we've seen, and it doesn't really change the story for us. Full credit to my friend and colleague, Mark Cabana, our head of rate strategy. He's been saying we think the cut comes in December and not sooner. And again, if we were talking in January, it was 6 to 7 cuts, then 5, then 4, then 3. So it's been moving in that direction. And again, we feel that from a high-level perspective, we are where we need to be. The Fed is where they need to be. Rate hikes will work if you give them time. There's a monetary policy lag. We're not even through that lag yet. Once we get through that, once deficits come down a bit, they continue to take out liquidity, rate hikes are going to bite. We feel we're in a good zone for the Fed right now.
Another bank, as we're speaking, really throwing in the towel here, JP Morgan crossing the wire, changes the first Fed rate cut expectation from July to not September like Citigroup, but November. Gargi, when do you think that we can see the first one actually happen here?
Sonali, good afternoon. It's so great to be here, and thank you for having me. I think that what the data today made us realize that July is definitely out of the picture. There's just not enough time for the Fed to gain that confidence that they're looking for. And as for the rest of the year, I think, both September or December are still probable. And I think they are going to be very data dependent. Chair Powell has told us that the data is going to direct them. And I think we just have to wait and see what the inflation data gives us over the next couple of months. And obviously, that'll start with next Wednesday. We're all looking for the CPI to continue to show a little bit more progress, coming down gradually, especially on the services front. And if we continue to see that deceleration in inflation, I think a 2 rate cuts starting in September is still possible. But as of right now, too early to tell.
How do you think of this trading strategy here, Matt? Because there are a lot of people who started this year getting into duration. And of course, you see what happened with the 10-year alone this week. So how much confidence do you have in terms of advising people to deploy across the curve when even the short term is so uncertain?
So we feel fairly confident that we want to be in a slightly long duration position right now. And to be fair, we've been that way for a while. We got the 4.5% to 5% range October, November last year. We liked duration. We had a massive rally as Powell got dovish to 3.8 on 10s. Now we got back to that 4.5 to 4 5/8 range. We're still positive on that. The way we look at it is that the Fed, we do believe, is restrictive. Let's assume, actually, that the Fed doesn't even hit 2% PCE. Let's assume they only 2.5. Let's assume they hit 3% PCE. Even at that point, the Fed funds rate of 5 3/8 is more than 2 3/8 over an inflation target well above the Fed's target. Give the rate hikes time. The 10-year just peaked in October, November. The Fed funds rate just peaked in July. Rate hikes take 12 to 24 months, come back to us in 2025, tell us they're not working. We do believe they're working. We're seeing it in the data, not as strong and as swiftly as some expected. But again, we always expected rate hikes to be back into this year. Hasn't really changed the story for us.
Gargi, how do you feel about the trading strategy right now, given what we know today?
Yeah, Sonali, the thing that we've been talking about pretty much from the start of the year is the fact that we do like fixed income here, but where you own duration is really important. So keeping that duration contained in sort of the belly of the curve, the front end to the belly, right around that 4-year point perhaps, and then recognizing that this is an environment not for owning duration, but for clipping coupon. So really allocating across IG, across EM, across high yield with active strategies that can clip coupon at these extremely attractive levels that, you can build a portfolio earning 6.5% yield, which normally you would look at a much riskier, much higher volatility portfolio, but you don't have to do that anymore. So fixed income makes a lot of sense, but stepping too much out in duration, I think you don't have to do that right now, given the shape of the yield curve and given the attractiveness of the front end.
Now, there's an idea brought forward this week by Pimco that has been getting a lot of attention. I want to get both of your thoughts on this. We spoke earlier this week to Pimco's Richard Clarida. He says he sees a generational reset on yields that will spur a bond revival. Take a quick listen.
Investors can get an equity-like return, 6 or 7%, without a lot of volatility or interest rate risk. So that's why our subtext is seize the yield advantage.
Now, it's interesting, you've seen the yield move significantly higher, but you're also seeing it's certainly a reset. How do you play that reset, Matt?
And again, we've had Dr. Clarida on calls. We agree with him generally speaking. This is a massive reset. If we were talking back in 2021, real yields were negative 2%. For the privilege of giving the government your money, you'd lose 2% in real wealth a year. $100 now is $80 of purchasing value. We're in the exact opposite direction now. It's 2 to 2.5% real yields across the curve on governments. This is an opportune time to make sure you have a robust fixed income portfolio. And because investment grade, high yield are basically pricing at a 0% chance of recession, we don't think a recession is likely, but we wouldn't say 0% chance. We're favoring rate risk because you don't have to take a lot of credit risk to get decent yields right now.
How do you feel about this, Gargi? Do you think that this is a generational opportunity, or is this a moment in time?
Absolutely. This is an excellent opportunity. But I think, again, like I mentioned earlier, where you play that opportunity is really important. So I think if you look at the very long end of the curve, and Sonali, you and I have talked about this before, if you go out 10, 15, 20 years out the curve, I think that there isn't enough of a term premium being priced in, given everything that we know around fiscal deficits, given the stickiness of inflation, given the uncertainty around elections. I think that, again, looking at the shape of the yield curve, being able to clip coupon in the 5-year part of the yield curve, and to Richard Clarida's point around building a high-quality portfolio with 6 to 7% yield, that is an amazing opportunity for investors, especially, now that we know investors are sitting in cash and we know rate cuts are coming, whether they come in September or whether they come in December, they are coming. And this opportunity to step out of cash to clip that coupon with fixed income, with ETFs or with active management makes a lot of sense.
Matt, what happens if the Fed does not get the opportunity to cut this year? What's the ripple effect?
So that's an interesting point. We've always said we believe we're at or near the end of the rate hike cycle. Even though we believe one cut's coming and more cuts are coming next year, we wouldn't take one hike off the table. But look what happened today. Strong jobs report. But did the 30-year sell off? Did the curve get steeper? No. The curve inverted slightly more, right? The 30-year was the least worst performing. So the Fed actually did have to hike. We're still not that concerned about longer duration. That would just be them getting ahead of inflation, trying to slow the economy. That really doesn't change our view on being so long duration because, again, you saw it today. Strong data was worse for the short end of the curve, not as bad for the long end of the curve. Again, look across the curve, 2 to 2.5% real across the curve. We're not that afraid of duration risk at this level right now.
Gargi, is there a risk that the Fed can't cut or even have to hike?
I think there is a risk that they can't go at all this year. I think the bar is high for them to cut, but I think the bar is even higher for them to hike. I think that if we continue to get some 0.3s, God forbid even a 0.4 on PCE or CPI, I can see a situation where they just hold off for this year, and that's fine. I think the market can handle that. Obviously, if we're talking about a hike again, and again, that is not the base case, don't expect that to be the case. I don't know how much they'll achieve at this point by hiking rates again. So as I said, high bar, but if we do continue to get much stronger than expected CPI and PCE prints, that could be something we're talking about. But Sonali, one thing I will point out that I think the bond markets were reacting to earlier this week is that we're a little bit in better balance in terms of looking at the labor market. Obviously, today with the unemployment rate picking up just a little bit, the JOLTS data showing a lot more normalization with fewer job openings, ADP. If you look at the totality of the labor market data, I think you're seeing a little bit of normalization, which is good news for the Fed.
Matt Diczok and Gargi Chaudhuri, what a great time to have both of you here. Of course, we have that CPI data and a massive Fed meeting next week. All eyes on that dot plot. But up next for now is the auction block. Donuts, burgers, and whiskey, all three are tied to credit issuance this week. Details on all of that up next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where there was a rush of sales before the ECB decision and U.S. jobs. We'll start in Asia, where dollar bond sales climbed for a third consecutive month in May, with new offerings since March up 50%. With the strong demand, spreads tightened to an unprecedented low of 141 basis points. And Japanese dollar debt sales have not been a part of this rush so far this year, but Suntory was part of U.S. high-grade sales this week, and the deal helped push weekly issuance to around $33 billion. And in U.S. high-yield, issuers bought more than $8 billion worth of deals. Notable names include restaurant brands and Brinks. And when it comes to credit, Invesco's Matt Brill says returns will come eventually.
We came into this year thinking it would be the year of the bond, and here we are 5 months in, and returns are basically flat on the indices, which they were down, so flat is starting to look like a little bit of a win. Going forward, we do believe there's significant money to be made within fixed income. So with signs like that cuts are on the way, I think it's sort of a wake-up call to everybody that this is actually going to happen. You know, the soft landing can occur globally as well as domestically, and when that occurs, you're going to start to see all-in yields go lower and the total returns pick up.
Now let's bring in Sonali Pier, portfolio manager for high yield and multi-sector credit at Pimco, and Michael Contopoulos, head of fixed income at Richard Bernstein Advisors. First question's got to go to the Sonali because we are the Sonalis on this show. What do you think about this idea of valuation here? This worry about you're not getting compensated really for the risk you're taking on, given how much money has flowed into credit right now?
Yeah, so spreads really have compressed. At this point, it's more of a yield story. So yields are still look compelling overall at nearly the 80th percentile versus history. And if you look at the yields, they're a pretty decent indicator of forward potential returns. And then in an active context, being able to add value through alpha with being selective, whether it's by regional selection, industry selection, security selection, and of course, asset allocation. So while the spreads are compressed today, there's still a compelling story for fixed income, and even more so, I would say, with the fact that we are discussing the potential down the road of the Fed cutting. We're talking about the fact that if we were to wait, we may miss the opportunity in some sense because of the yield that's being produced today, and being invested for that. It makes a lot of sense.
Michael, how much risk are you willing to take on at this point in the cycle? Of course, those rate cut expectations, whether or not you believe you'll see one or even more this year, they're still pushed out. And does that mean that you'll see more stress in the system?
Yeah, Sonali, I think eventually we'll see more stress in the system, but the Fed's just not tight enough at the moment. Everybody, your previous guests were talking about how, the Fed is very tight at the moment, is restrictive. I totally disagree with that. There's no indication that the Fed is that restrictive at the moment. Look at Bitcoin, look at meme stocks, look at the equity market, look at credit spreads, look at the housing market. Nothing out there suggests restrictiveness. And so I wouldn't expect any sort of catastrophe or blow up that's imminent, because quite frankly, the economy is pretty healthy and it's absorbing these rate hikes pretty well. But eventually, of course, either the Fed will have to get restrictive or earnings will fall or something will happen that will cause a drop in yields and the Fed to ultimately cut. But as I look out over the next several months to several quarters, it's hard to really justify that that's going to be anytime soon. And so from that vantage point, listen, I mean, credit in particular, on a fundamental basis looks great, but I think on a valuation basis, you've really got to look elsewhere other than just corporate credit at the moment.
Well, it's interesting, Sonali, when we were talking to our previous guests too, this idea of not needing to take on too much credit risk to get returns in the bond market. Where does that leave you with the propensity to still take on credit risk, given where we are in the cycle right now?
Right. So I think, the trade-off here is, are we looking for economically sensitive securities, or are we looking for securities that can produce attractive, high-quality, low loan-to-values and still an attractive yield? And so, we can do this in a multi-sector credit lens, through agency mortgages, through financials over non-financials within investment grade, looking at those national champions. We can do it with securitized credit over corporate credit in some aspects, but there are some parts of the corporate credit market that still look attractive. So, within securitized, ideally we're, focused on some areas like residential mortgage securities, and, think there's a fair amount of opportunity and resilience in those securities.
You're talking about resilience, but do you think that defaults are going to pick up elsewhere in the system, Sonali?
Defaults have been relatively low, and even if they pick up off this low level, we still think pretty much in line with the long-term default rate, both in the high-yield market and in the bank loan market. And a lot of this has to do with, many issuers have pushed out their maturity wall, right? There's not this maturity wall looming. They've refinanced when rates were low in back half of 2020 and in 2021, such that, there's not this trigger for a high level of defaults. Furthermore, with covenants having been so loose over the last decade and a half, we're seeing issuers now coming, when it's difficult to issue an unsecured piece of paper, they're coming with a secured bond or embarking on liability management exercises, distressed exchanges, to avoid the actual bankruptcy.
Now, Michael, if you could take a look at just how much money has poured in, including into credit risk, do you think that people have maybe gotten in a little above their skis, or do you think they're safe, just given that people don't think the economy is going to turn this materially so quickly?
Yeah, listen, I think it's a little bit of both, quite frankly. It doesn't make for great television, but I agree very much with Sonali. This isn't necessarily a fundamentals story. And so is there an imminent catalyst to significant spread widening and price loss in corporate credit? Maybe not, although one could argue that there's a huge correlation between rate volatility and equity volatility to credit spreads, and credit spreads, any sort of increase in either one of those types of volatility will cause spreads to widen. And that can happen for all sorts of reasons. But generally speaking, listen, it's not a fundamental story here. It's really a valuation story. And so from that vantage point, I very much agree with what Sonali said before. Securitized products, and I'll throw in there in addition to residential mortgages, agency-backed securities, but also CLOs. Why go and buy a 5% investment-grade corporate bond when you can go and buy a 6 to 8% yielding either AAA or BBB CLO with AA or better default risk? To me, that's a much better value proposition than owning just the investment-grade corporate bond market. You take less risk, you get more yield, and then you can use treasuries to manage your duration any way you want.
Michael, real quickly here, you have about 30 seconds. What is your favorite trade right now then?
Well, I think I just mentioned it. I think looking at CLOs, collateralized loan obligations, and in the securitized market, definitely our favorite trade. You can take your risk there, and then you can modulate your duration using treasuries. And I think that's going to create a much better risk-return profile than just buying, run-of-the-mill investment-grade corporates or munis or anything of that nature.
Oh boy, do I wish we had more time. Would love to talk about those leveraged loans that are feeding that CLO engine. Our thank you for now to Sonali's Pier from Pimco and Michael Contopoulos from Richard Bernstein Advisors. Certainly an interesting time right now in credit. Now, still ahead, the final spread, the week ahead, huge week. We're going to get a Fed decision and a CPI print. We'll talk about that next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the final spread, the very busy week ahead. Coming up Monday, all eyes on Apple's Worldwide Developers Conference, and Tuesday, the U.S. Treasury selling $39 billion of 10-year notes. Wednesday, the latest CPI print, plus a Fed rate decision and Chair Powell's news conference. Thursday, the G7 summit kicks off in Italy, and more U.S. eco data rolling out, PPI and jobless claims. Finally, Friday, it's the Bank of Japan's turn for a rate decision, plus UMISH consumer sentiment. And for my final thought, closer look at those estimates for CPI. Of course, complicated story when it comes to inflation, and you have to wonder if it's the only part of the story here anymore after this jobs report. But you do see an estimated cooling of month-over-month CPI to only 0.1%, with the prior being 0.3%. Let's see if next week delivers. From New York, that does it for me. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.